In this lesson, how to use Keltner channels, the learning objectives are: you should know how to calculate Keltner channels, you should know different strategies to use to help you trade using Keltner channels, and you should know the difference between Keltner channels and Bollinger Bands. At an immediate glance, this may look like Bollinger Bands, but it's slightly different. Keltner channels are also a volatility-based indicator. Keltner channels are a combination of a exponential moving average and the average true range indicator. As the channel is derived from the average true range, which is a volatility indicator itself, the Keltner channel contracts and expands with volatility. Keltner channels help you set trade entries and exits, and they help identify overbought and oversold levels relative to the moving average, especially when the trend is flat. Keltner channels attempt to cover most of the price movement. If the pair is trading above or below one of the channels, it indicates that the pair has overextended itself, meaning it is overbought or oversold, but we'll get onto that. The Keltner channels will always adapt to the current direction of the trend and the current volatility level. It is a lagging indicator, which means that a very quick or overextended move tends to result in a price breaking one of the lines. This is a real world example. As you can see, often price does break the lines, but the average true range then envelops it again later on. As you can see, breaks the line, but it goes back into the channels. Here is how you calculate the Keltner channel. The middle line is the 20-period exponential moving average, and the upper band is the 20-period exponential moving average plus 2 times the average true range in a 10-period. And the lower band is the 20-period exponential moving average minus 2 times the average true range in 10 periods. The multiplier is what determines the distance of the upper and lower Keltner band to the moving average. By changing the multiplier, you change the width of the Keltner channel and the number of times the market closes above or below one of the Keltner bands. The most appropriate Keltner channel multiplier usually is somewhere between 2 and 3. However, as with everything, it varies with the market as well as with your strategy. In order to know what multiplier you should use, you could look at a chart and visually determine the multiplier that would suit you best. To do this, look where most of the price action is confined. For accurate signals, make sure most of the price action is within the lower and upper band. The multiplier can also be adjusted based on the market you are trading. While 2 is the default setting, you may find that a 1.6 or a 2.4 provides you with better information for the exact market you trade. Increasing the multiplier will result in fewer signals, but will increase the accuracy of the signals you get. The higher the multiplier, the wider the channel, and the smaller the multiplier, the narrower the channel. You should know that intraday trading tends to be very volatile compared to longer term trading, so I would advise you use a higher multiplier. Also, with lower time frames, market noise increases as well, so if you intend to use lower time frames, you should also increase the multiplier. The exponential moving average period can be set to anything you need. The default setting is 20, but you may try to experiment with shorter or longer lengths. I would recommend use maybe 15. You would find that some markets work well with the standard settings while others do not. The key to finding out what settings work best is to backtest. What a market will do once it is overbought or oversold varies. Some pairs have an inherent tendency to revert to the mean, which means to go back to the middle, while others trend. Therefore, signals issued from a breach from one of the Keltner bands could mean different things depending on what pair and time frame you trade. For example, a mean reversion trading strategy using the overbought and oversold concept with Keltner channels will work very well for major pairs on a daily time frame. However, if you change the time frame to 5 minutes, the chances are the strategy would fall apart. Crosses tend to trend, so if you were able to apply a mean reversion strategy with Keltner channels, they wouldn't work too well. Instead, I would recommend that you would use breakouts from the Keltner channel, as that would work better in this type of market. Let's look at the first type of strategy, a mean reversion strategy. Mean reversion is the tendency to revert to the mean, or the middle, once price has moved excessively or too quickly in one direction. The channel top typically holds a dynamic resistance, while the channel bottom serves as a dynamic support. One of the most common applications when using mean reversion is to buy once price approaches the lower band, as that indicates the pair is oversold, and when price approaches the upper band, this signals that the market is overbought and is about to revert soon. So it would be a good opportunity to enter a sell position. Having filters helps to ensure that the market is actually about to revert. The RSI indicator can help filter false signals, as it can be used to identify oversold and overbought conditions. I would suggest you use 2 indicators to confirm something is overbought or oversold. The next type of strategy we're going to be looking at is a trend following strategy. As I said, this works best for crosses. During uptrends, price action tends to be confined in the upper half of the channel, with the middle line acting as a support and the top line as resistance. During downtrends, price action tends to be confined in the bottom half of the channel, finding resistance in the middle line and support at the bottom line. With the trend following strategy, the upper and lower bands of the Keltner channels work as breakout levels. So if the market closes above the upper Keltner band, that could be a signal that the market has started a more significant upward phase. So it would be a good opportunity to enter a buy position. Conversely, the market breaking the lower band could indicate that a longer period of downward movement is going to occur. So it would be a good opportunity to enter a sell position. Personally, I would prefer to use the knowledge that uptrends stay in the upper half and downtrends stay in the lower half, because that tends to be more profitable than relying on trend breakouts, sorry. But to reiterate what I said, looking for channel breakouts will help you catch a big move as early as possible. The middle line is a very significant level, since it tends to act as a pullback level during ongoing trends. So I would use it as a stop loss level. There are many ways to limit the number of false breakouts. One of the most effective ways to avoid false breakouts is to only trade using this strategy when the market is trending. One of the most common ways of determining the long-term trend of the market is to use the 200-day or 200 period moving average. If the close is higher than the moving average, you are in a rising market. And if the close is lower than the moving average, you are in a falling market. What is the difference between Keltner channels and Bollinger Bands? Keltner channels are smoother than Bollinger Bands. This is because Keltner channels use an exponential moving average, whereas Bollinger Bands use a simple moving average, and Keltner channels use the average true range to calculate the width of the price channel, whereas Bollinger Bands use standard deviation. The smoother line is the reason why many consider Keltner channels better suited for trend following strategies. So recap all the points. In summary, Keltner channels work both for mean reversion and trend following strategies. The default settings are 20 for the moving average, 10 for the average true period setting, and 2 for the ATR multiplier. The Keltner channel is smoother and more responsive than Bollinger Bands.